we are going to start talking about overhead variances. So overhead can be split into fixed and variable, and the fixed and variable can be split into spending and efficient. The variable can be split into spending and efficiency, and fixed can be split into spending and volume. So just like materials and labor, the price could change, right? So we need to figure out that. Is it just because the cost of this stuff went up? Or was labor being maybe not as efficient, and so it took more hours, so therefore it took more overhead? So that's what we're trying to figure out. So there's kind of 4 variances going on with respect to overhead: fixed and variable spending, and then variable efficiency and fixed volume. And it's really just because, same idea. Either the price can change, or we don't use our resources as well as we expect under the standard. All right, so materials overhead spending variance does indeed have a formula, right? Actual variable rate times actual hours, standard variable rate times actual hours. So that's going to give us the spending variance, right? Because we've stripped out the hours. They're the same for both. Efficiency variance, right? Strips out the rate and looks at the difference between the hours, right? So here's an example of a spending variable, right? So these variable overheads are certainly things like electricity, gas, water. The more we produce, the more we use of those. So we have our budget, right? So the budget allowance is using a cost formula, right? Per direct labor hour, we're using these, right? And so if according to the budget, right, we ended up with that, but what we actually spent was this, right? So we calculated this, we actually spent this, the difference is, and again, favorable versus unfavorable. We actually spent less than we budgeted, so that's favorable, income increasing. Here we spent more, here we spent more, so unfavorable. So that's the overall, and now we split out, and this is like the formula. It's the same thing as the formula, but we've just written it in columns. You know, you don't have to write it out all these columns for the exam. You can just apply these formulas. All right, just these formulas are fine, but you can write it out in terms of columns, subtracting from each other, and it ends up being efficiency and spending, and you can split them out. All we've done is take that spending variant, that budget, and split it out to show us the efficiency also. All right, fixed has the same thing going on. You can have a fixed overhead spending variance and a volume variance, and you have the formulas for those. Actual fixed overhead spending variance is the actual fixed overhead minus the budgeted fixed overhead, and the volume variance, budgeted fixed overhead minus applied fixed overhead. It's pretty simple. Well, the reason fixed is simple is, well, it's fixed, right? You don't really multiply things times the units. So you just look and see if it's more or less, and that'll tell you if it's favorable or unfavorable. And so there you go. And truthfully, you shouldn't have that big of a difference in your fixed overhead, right? So depreciation, you totally have the call on that. But again, you can get a little off. You can estimate it based on last year's and it turns out to be a little more. So again, actual budgeted, the difference is your variance. Let's stop here and we'll just finish up with the talking about variances on the last video.